Today, my guest is Paul Moore. Paul is an accomplished entrepreneur. He's an engineer with an MBA, started his career at Ford Motor Company. He started and ran and sold a staffing company. He's done a bunch in real estate. He's appeared on HGTV real estate episode, or an HGTV real estate episode. He's renovated, he's managed, he's developed, he's invested in multifamily, and he's a regular contributor to Bigger Pockets. He's also the host of the intriguing podcast, How to Lose Money. We're going to talk about that with him. But first, a quick reminder, if you like the show, please let us know. You can do this. You can give us a like, you can leave a comment, you can share the show, and certainly you can subscribe. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, Commercial Real Estate Pro Network. All right. Now that we've got through that, let's welcome our guest, Paul Moore. Paul.
Hey, it's great to be here.
I'm so looking forward to our talk today, and we will get into this a little bit. But before we do, if you wouldn't mind just taking a minute and sharing with listeners a little bit more about your background.
Yeah, so actually, I was pretty misguided, I think, through high school, and I didn't have any idea what I wanted to do. I actually wanted to be a parapsychologist. I like the movie Ghostbusters, and I thought that sounded like a good idea until I found out that no colleges, at least that my parents would pay toward, had a degree like that. So I went to the opposite end of the opposite extreme and decided to become an engineer. It sounded fun. And I realized that really wasn't me as much as I had thought. So I got an MBA, thankfully, after that. Went on to Ford Motor Company, like you said. And then we started a staffing firm and did that for about 5 years. We sold it to a publicly traded firm about 5 years later. And I thought, semi-retirement in your mid-30s sounds glamorous and exciting. And I know a lot of people dream of stuff like that. But it was miserable. I actually became the worst version of myself, worst father, worst husband of any time. We have 4 kids now. We had 2 at the time. And actually, I think because I wasn't living out who I was meant to be, I wasn't living out any part of my created destiny, if you will, that I became more and more unhappy. I don't think I realized how much, but that's when I went to the courthouse steps and decided to buy a house for probably 50% of its value and started flipping houses. And that's how I got into real estate back in 2000.
Gotcha. So it started on the courthouse steps, huh?
Yeah, it did.
And sounds like it was more out of boredom. Is that, or you were looking for something to do? Is that?
It was boredom and kindness. I had a friend who moved to town and he didn't have a job and he had all these great skills. And so I said, well, why don't we go? I got some cash. Why don't we go buy a house and get something, give something to do, and we'll see if it works. And it actually worked incredibly well. I'm glad that first one went better than the next 3, because I don't know if I'd have stayed in it if it hadn't, but we made like $25,000 in literally 3 weeks. We put a FSBO, for sale by owner, sign in the yard at 8:30 a.m. and it sold by noon, and for full price. And so we thought, this is easy. We can do this once or twice, 3 times a month easily. And of course, it wasn't that way. That providentially turned out to be a great deal. And I'm really glad. And I don't think I ever thought of that till just now, that if it hadn't been such a great deal, I don't know if I would have had the courage or the desire to do it again. And it was kind of same with entrepreneurial ventures. I've done a couple dozen entrepreneurial things, including all these real estate things. And the first big one, the staffing company, turned out so well. I think it gave me the courage to go on, instead of going back and getting a job.
No, I'm sure that that helps out tremendously. As opposed to continuing to fail and fail and fail, and just the next one's going to be right. The next, just one more time. So, because you hear, or I've certainly heard and read, and there's certainly numerous examples cited where the path to success is through failure and all that. But I agree in that it would certainly temper your enthusiasm and maybe your spouse and your support staff, to stay with you through that if you continue to struggle. So that's
right.
great.
Very true.
That's great. So your story then, you started off with a flip, just a single family flip. That was it.
Yeah, that was it. And then we did several more, lost money on two of the next three, I think. But yeah, then we went from there. We thought, after doing dozens of those, I thought, well, if it was probably 2 dozen at the time, I thought, well, if this works, how much better would it be to build ground up? So I said, okay, let's go buy some lots and build modular. We built 7 modular homes and actually made money on probably all 7, or at least 5 or 6 of the 7. And then I thought, now it's time to build a stick-built home where the real money is. And that was smart. You know, for a guy who can't hang a doorknob on my office door, building a house from the ground up was not smart. And so we should have easily made $80,000 to $100,000 profit on that house. Instead, we lost 40,000.
Oh, wow.
And so that jettisoned me out of the building space quickly. But we did start. We had bought some lots, and we ended up buying a lot. A friend of mine and I bought a number, probably 2 to 3 dozen high-end waterfront lots at a beautiful resort in Virginia called Smith Mountain Lake, and that was spaced over 4 years. So we bought these lots. We would go in and clear the lot, and then resell it for a really nice profit until we didn't, when the downturn hit.
So you mentioned this kind of progression. How long were you doing the flips? How many years did you stick with the flips?
Probably 4 years with the flips, 2 more years, and probably 3 years straight with the flips. And then we did more after the recovery in the last 5 years. But 3 years with the flips, a year and a half with the construction, 3 to 4 years with the lots. And then I've done quite a few things since then, including building multifamily, a hotel, etc.
You mentioned the modular. Is that mobile home, or is that...
No, these would be stick-built homes that are pre-manufactured, put together in a factory, and it's very popular in this part of the country.
Okay.
So these evolved from mobile homes to double wides to manufactured homes. You know, basically they're built to regular home standards, but they're built strong enough to be able to put on a trailer and take down the road at 60 miles an hour and place on site. There are limitations, but other than a few of these limitations, they're generally just like other stick-built homes.
Got it. And so your entry into real estate, again, it was more of a... I keep thinking of, like, most people that I've talked to have like some sort of... They're looking for the easy path, or the way to make money, or the way to get rich, or something like that. And it sounds like you had already experienced all this. This is more of like a curiosity, and like you said, something that you had a friend. Was it? Did you look at it as a potential vehicle, as a ongoing business, or did it become that?
Mm-hmm. I think it became that. Yeah, after we realized how much fun it was. You know, they say when you enjoy your work enough to the point where people can't tell if you're working or playing, it becomes something that you should consider doing, especially if you're good at it, and especially if you can make a profit at it. So all 3 of those pieces came together for us when we were flipping homes. And I remember driving around my car, in the car with my friend Jack, and saying, how could this ever get old? This is so much fun. We were looking for houses to buy, to flip, and it did get old. But at any rate, it was fun, and it did become a business.
Got it. And as far as financing, were you financing all of these yourself, or did you use any outside financing?
Yeah, we did. I mean, at first I financed several myself, and then we began to borrow money from a local bank who gave us a line of credit, and then they increased that line to allow us to buy, I think it was up to 5 houses at a time we could carry before we had to sell one or, refinance out into permanent loans.
Okay. So in comparing real estate to, your other ventures, the staffing business sounds fascinating, just based on, the economy and supply and demand and the mobile economy and all that. But can you describe some of the benefits you realized in real estate that perhaps weren't in the other? I mean, you mentioned the fun aspect.
Yeah.
But are there some other benefits, and when you compare real estate to your other entrepreneurial ventures?
A lot of, home flipping can be very transactional, and a lot of the other things I did in the past were more transactional in nature. But since I've gotten into commercial real estate, which we haven't talked about much yet, I found that it was a way to build and accumulate and hold on to wealth long term. I just did a great deal, for example, that I'm actually going to make very little cash on, but 5, 6, 7 years from now, it's going to, put our family, it's going to be a great payoff at the time. And I love that nature of it because it seems to have a future orientation. In fact, I call my book, in my book, I talk a lot about building multi-generational wealth. And I think real estate, I won't say it's the only way, but it is certainly a unique way to do that.
No, I totally concur with that. I didn't mean to stop your story as much as I'd love to hear more about. So you got into a little bit of the development stuff, and I'd love to hear more about the progression from that to this commercial. Can you take us through that?
So sure. So I got a phone call right about the time I realized we were about to lose $40,000 on this house. A contractor had talked me into buying him a bulldozer. How do you do that? But anyway, in exchange for doing drywall work, which, by the way, I had to redo later. It was a nightmare.
Wait. You've got a drywall contractor using a bulldozer. Those tools don't sound like they go together.
He was a jack of all trades.
Okay.
He was great at everything, Darren.
Okay.
I mean, he told me so.
All right.
Just ask him.
All right. Gotcha.
But anyway, no, he was one of the main contractors we used in the house. But about the time I was realizing this was a big loss, I had spent 8 months just pulling our hair out, over this $40,000 loss. I literally got a call from David Stevens. He said, "Hey, I'm Dave Stevens, and please don't hang up. I run Freddie Mac. He didn't say I run Freddie Mac, but he said I'm the senior vice president of Freddie Mac, and I think he literally did more or less run Freddie Mac, from what I understand from other people there that I met later. But he said, look, I'm looking to buy a home at Smith Mountain Lake in Virginia. I see you're a builder there, but I saw you have your real estate license. Is that right?" I said, "Yeah," because we had to put on this. We had a beautiful website, smithmountainhomes.com, and we advertised. That I just mentioned that I was a realtor. He goes, "I've called 7 realtors. I think I was the 7th or something." And he said, "No one's called me back. Can you help me?" This was in the boom of 2004, and I said, "Sure, I can help you." And I made like $16,000 in commission in like probably 25 hours work. And I thought, hey, wait, this is a better idea than building. And so I set up a residential website. It was right before Google AdWords really hit hard. And so pay-per-click marketing, I became a self-proclaimed expert in pay-per-click marketing for real estate. I set up this website. I eventually found 7 realtors to feed leads to, and 14 years later, we're still doing that. And that's kind of my base income I get from that business while I go out and pursue these other fun things. So did that. And then 2008, when everything dried up, I will circle back to this later, but I found myself $2.5 million in debt. And I'm pretty discouraged with real estate. I kept Smith Mountain Homes going, thankfully. And I went out and learned copywriting. I actually spent a couple years learning marketing copywriting, which I hardly ever mentioned in my story. But through that, I actually got involved in drilling some oil wells in North Dakota, of all things. And my friend and I realized my business partner has a small jet, and every time we would fly to North Dakota, realized there was no place to stay. He had to fly back out of North Dakota to South Dakota or back to his home in Colorado. And so he said, hey, we're both in real estate development. Why don't we build a hotel or multifamily to house a lot of these guys? There were guys, literally pickup trucks, Darren, lining the roads. And I know a lot of people from Oregon and Washington were there because I met a whole bunch of them over the years. But we built a beautiful multifamily quasi-hotel to house these guys, mostly men, who were sleeping in pickup trucks. And we were charging literally, let's put it this way. In the heartland of America, the rent per square foot per month is roughly $1 per square foot. In other words, an 800 square foot apartment in Kansas City might rent for $800, right?
Right.
We were charging 13 times that.
Oh my
We were
God.
charging $13 a square foot per month, and we were staying almost full. $4,000 a month for a 300 square foot, beautifully decked out, fully furnished apartment for these guys. And so it was a fun ride. I learned something about hotel, learned something about multifamily. We sold that when oil was about $90 a barrel, and it literally plummeted right after that into the 30s. Unfortunately, we were building a very high-end Hyatt hotel at that time, and that was also in North Dakota. And I learned so many lessons through that, but it did not end up well. I'll say that. And
So these were all ground-up construction projects?
yeah, the multifamily was actually it was a series of dozens of beautiful cabins. I'm picturing it in my mind going up the road on the hill in North Dakota. But yeah, they were really high-end cabins. I mean, the furnishings, the appliances were as nice as people, maybe nicer than at home. And so we wanted to be the last one standing if oil prices dropped. We figured, hey, the Bakken oil boom's on. If prices ever go down, we want to be the one that people flock to when the man camps empty out and there's still people in town supporting the oil production. And that's exactly what's happened. We did sell it, but the company we sold it to has actually done pretty well, though a lot of other ones have packed up and left town.
And I'd love to hear more about your, was it a Hyatt, did you say, or the, what was
We have to talk about that, Darren?
Well, I mean, it certainly piqued my curiosity. Again, ground up construction, and sounds like, did you get caught in the bust? Was that some of it?
I mean, painful on so many levels. So number one, we were in Minot, North Dakota. We chose the wrong city. It was supposed to be the next Houston or actually Dallas of the oil boom. It was more where the executives came and went. All these oil companies were setting up beautiful locations there. The Williston and Watford City and Dickinson, North Dakota were more the smaller towns that supported the oil boom, but we went to Minot. And we picked the wrong town, wrong location in the city. I won't get into for time's sake, but we chose a location based on speculation of where the city was being developed. And actually that area has developed, but it was a lot slower than we planned. Third, we picked, again, to put the nicest Hyatt house in America in that town. It was honestly a mistake, I think, because when oil prices plummeted, people in Minot said we're not dependent on oil, we're dependent on all kinds of other things. But yeah, it wasn't supportive. There was all kinds of other mistakes made, including things that were outside of control, like a general contractor who didn't steal a bulldozer, but he just stole $1.5 million from us. We had paid him thinking, of course, that he was paying his subs all along, and found out like 60 days into one point in the project that he hadn't paid his subs. And he ended up going bankrupt as soon as we called him out on it. So we have, of course, had to not only lose that money, but we also had to go pay those subs to keep them working, and because it was the right thing to do. So we found ourselves quickly $3 million in the hole, and then more, because of the record cold winter and all kinds of other things. So it was a very difficult experience. Some of it was our fault, some of it was not. But I learned in that, number one, that I love, in those two experiences, I love commercial real estate. And I also learned that I am not suited for ground up development. I realized I was 50 years old. And I thought, if I would have been 60 or 70 and something like this happened, playing double or nothing, and if I would have been on the nothing part of double or nothing, what would my family have left? And I realized I wanted to build some long-term, stable, multi-generational, if you will, wealth. And that's when I plunged back into a path of the last 5 years of learning multifamily and other commercial real estate, more not the development side, but more the value add, working with existing properties.
In your lesson there in North Dakota and the loss, Was this debt that you had guaranteed yourself, or was it secured, or was it just cash you were putting up, or?
It's interesting. The multifamily quasi hotel, if you will, yeah, that was guaranteed by all of us. It was cash the three of us, had put up, and it went fantastic. So happy that happened and made a lot of money. The hotel, my business partner, the guy with the jet, had taken 20 years of other businesses he had rolled profits forward from, and kind of all culminated in this beautiful Hyatt. And so he actually did it solo. I found the real estate. I connected him with Hyatt after interviewing other companies like Marriott, Hyatt, etc. And I actually helped him staff it, and I helped him do the marketing. But honestly, it was on him, and he took a terrible loss, but he's doing fantastic now.
Gotcha. So we talk about, and I look at my notes here. I think there was some reference to riches, or was rags, riches, rags? I can't remember. Are we out of the rags, and are we back into the riches? I mean, the commercial real estate, is it been? I mean, it sounds like you found a passion in commercial real estate, and again, the aha of the multi-generational wealth, which to me has always been, and I don't know that I've thought about it as, quote, so much about multi-generational wealth, although that is truly what it is, as much as just the long runway of the power of, whether it be leverage or time and other people paying. And even in a market where there's no appreciation, just the fact that they're building the equity, if you're leveraged in something, to me it's always just in that cash flow, the cash flow that's not dependent on the stock market. If the market goes down 30% and you're on a fixed income and you're counting on a return from what you have in the market, and all of a sudden that gets reduced by 30%, that changes your plan. Like you said, if you're at 60, whereas even if you lose a tenant, you may lose a little cash flow, but you still have the asset, and there's still a potential to put another tenant in there, and then rents going up and beyond there. But so I'd love to hear a little bit more about your aha in commercial real estate.
Yeah, and I'll circle back to the rags to riches again.
Okay.
But because they're not exactly related. But what I realized was, hey, I was looking for something, and it was a tall order. I was 50, and I was like looking for, where can I look decades ahead and see the trends and know that this is something that I can do to build wealth and hopefully pass along to one or several of my kids who might want to get involved in the business. And I was looking at the demographic trends, and Class B multifamily fit the bill in almost every way. Number one, the government had tampered with the housing market in the 90s, and home ownership shot up from the low 60s, where it was historically, up to 69+%. And then in 2005, the cracks began to show in the foundation, and then 2007, 8, 9, et cetera, and then on to 2015, home ownership dropped like a rock to 63%. And every 1% drop represented 1 million new people in the renter pool. At the same time, there was not a lot of new multifamily being built during the crisis. So the supply and demand went pretty crazy. And the bottom line is there were more tenants than there were available rental units in a lot of ways. I mean, I don't know that I was quite this thoughtful, but in retrospect, looking back at it, there were three major reasons for this situation. Number one, we've got baby boomers. Now, baby boomers, which I imagine might include you almost, but it includes me. And baby boomers are the fastest growing segment of renters in the United States. And the statistics show that when we rent, we never go back to owning a home again. Baby boomers realize that perhaps the American dream didn't necessarily include home ownership. They saw a lot of their equity, their life savings evaporate before their eyes. Sometimes they lost their homes. Sometimes they chose to downsize or rent. And so that's still happening. Second group is millennials. Now, they're the largest demographic group in U.S. history with 80 million strong, and they largely prefer renting over buying. And that could change, as we've seen in recent months. There's been some rumblings that might change, but millennials have record student debt and record other debt. Millennials generally wonder why they should be tied down to a 30-year contract on a seemingly overpriced home when they may get new friends, new adventures, new job opportunities across town or across the nation, next year. So they generally have been more prone to rent, and that's a big factor. A third large factor is immigration. Immigrants generally rent more often and for longer than folks born in the U.S., and they are continuing to play an increasing role in the U.S. economy. So for those three reasons, I felt like I was able to look down the road and say, hey, this is a great business, and it will be for a long time. So that's why I got into multifamily. As far as getting from rags to riches, it's been a really tough thing, Darren. I mean, I wrote a book called The Perfect Investment, but the perfect investment isn't perfect if it's so overheated. Any assets, any apartments that make sense to buy. And here we are in the summer of 2018 as we record this, in a situation where it's almost all overheated to the point where you have to wonder if it makes sense. And our company, all the partners have made a lot of money, and we've lost a lot of money in various real estate and other ventures over the years. And we were committed to not overpaying for apartments or any other assets. So we're at a point where we're having trouble finding apartments that make sense to acquire. So I won't say we're into explosive riches and success at this point, but we are finding some paths forward, which we could talk about if we have time.
I'd love to get into that. I wanted to ask you just a little bit, because I think the things that I've heard you talk about up until the multifamily story sounded more like kind of like a hunch or like let's do it. Right. Whereas when you laid out this multifamily case, you gave three reasons why. I mean, it looks like you stepped back and you studied it, and I'm wondering. I'm partly reflecting on my own experience. I feel like I'm more of the guy that will open up the box and throw away the instructions and, try to put something together and find out I've got either, parts left over or, there's a step that I missed before I glued everything together that was supposed to happen, and now I've got to go either buy a new one or break it to, put it back together. Am I hearing you right? Did you really kind of take a reflection and really kind of become a student of the market? It sounds like maybe that the North Dakota situation opened your eyes to market. Mm-hmm. I mean, am I hearing you right?
Yeah, you're absolutely right. To market and asset class. I realized I had, as a highly driven type A entrepreneur, I realized I had spent my life swinging for the fences. And, Babe Ruth's story, he swung for the fences, and he's one of the most famous home run hitters in history. But he, as many of us know, he was also a strikeout king. And, I just decided, that was fun in my 20s and even my 30s. It wasn't so fun through my 40s, and it's going to get less fun as I get older. So I just realized I want to look for asset classes that are where I can, for my family and for our investors, we syndicate multifamily now. For my investors, I want to find stuff where I can hit singles and doubles, but have safety, stability, predictability, and where it can be truly not speculating, but investing, which is very different.
No, agreed. You mentioned, the market, you think it may be overheated. It's tough to find deals. Can you talk a little bit about what you're doing or what your parameters are? What you're
Absolutely. 93% of the multifamily over 50 units in America is owned by companies that have multiple apartment complexes, and I would call them professionally run companies. However, about 80% of self-storage facilities are owned by single owner operators, owners who own one self-storage facility. I would basically say they're independent operators at best, mom and pops at worst. And self-storage has very similar risk return profiles during bad times and good that apartments did. So we just realized, there's 53,000 self-storage facilities in the U.S. That's about the same as all the McDonald's, Subways, and Starbucks combined. About 40,000 more or less are owned by these mom and pop operators and could be dramatically improved if professionally managed and marketed, et cetera. So we didn't really ever want, like I said, my book's called The Perfect Investment. It's about apartments. We didn't really want to get out of apartments, but we realized, hey, we've got over 200 investors who trust us and they're looking to us for, a place to park their money and grow their money. And we realized, we weren't serving them by just continuing to stubbornly say we're holding out for the next apartment deal. We did a great one about 7 months ago, apartment multifamily deal with 125 townhome units. But what if it's another year until we find another one? So we actually decided to co-invest, if you will, with another professional operator in self-storage. And so we just did about a $2.9 million investment into one of those. And it's, I'm really excited about the future doing that as well as looking for apartments at the same time.
I love to hear that. I think so many times the message is, focus on an asset class and, stay in your lane. And I think there's a lot of power to that. But I think what you're seeing and what I've seen with some of my most experienced insurance clients that are in real estate is recognizing the market moves. And, if you stay in that market and you write it up and then you write it all the way down and then you write it up and you write it down and you write it up and you write it down, it gets pretty, there could be a time where you don't get to write it back up, right?
That's well said. That's right.
And if you recognize that, once something goes up, there's something else that hasn't yet taken off, or there's another opportunity, and you keep your eyes, peeled and you kind of head on a swivel, recognizing the trends, and you understand the market. I think that's because what you haven't commented on, and I'd love to hear a little bit if you got just a second to talk about, is the relationship between multifamily and the self-storage. Have you found any correlation between that, or are they totally separate?
Well, so here's a couple thoughts on that, and you can conclude if they're related, because I don't know that I've thought about it as well as you asked there. But number one, in the downturn, in the Great Recession in our area, it started earlier than 2008. But at any rate, we're near DC. I think they had caught on to it sooner. But at any rate, we found that people, as they were being downsized out of their 4,000 square foot homes, they were moving to rental houses in some cases and apartments in others. Well, what else happened? They often had a lot of stuff to store and they weren't willing to part with it. And so at those same times, a lot of those folks would be willing to go into a storage unit. Now, they might have had a 4,000 square foot home going into a 1,000 square foot apartment or a 2,000 square foot home. And a lot of them, self-storage tenants have the impression that this is very temporary. A lot of apartment dwellers realize they want to do this for a long time. But a lot of self-storage tenants say, I'm only going to do this for 3 more months, and then my wife and I are going to go clean out the storage unit, or my buddies and I are going to go sell some stuff on eBay or get rid of it on Craigslist. But it's only $100 a month compared to their $1,000 a month rent. And so when they get a 6% rental increase, the tenant of the apartment might be willing to move out for that $60 a month. But the tenant of the storage unit at, let's just say, $100 a month with a 6% increase will probably not spend a Saturday, rent a U-Haul, get their friends, and move all that stuff down the road to another storage unit for $6 a month, especially when they realize that, when they believe at least, that they're only going to be there 3 or 4 more months. And so self-storage actually, after a brief lull, just like apartments had in 2008 or 9, actually did very, very well during the recession. And so I think if I was going to tell you ways that those two were related, I think that would have to be the best way I could tell you.
Oh, I like the stuff. I think Americans we love our stuff, and we got to have more stuff. And when you don't have enough room for your stuff, you got to get more room. So
that's right.
Storage for your stuff. That's great. Paul, I want to ask you a couple of questions here. So, is there something that you found in your real estate investing that surprised you that you hadn't? I mean, we've talked about a lot of things I think probably surprised you, but is there one thing that stands out that was a surprise when you look back?
Yeah, I mean, I think that I think what surprised me is that even, you think of real estate, and I mentioned being $2.5 million in debt in the recession. And you think about real estate as being, really safe and a solid asset. It's not like speculating on crypto or even stocks that can go up or down based on a CEO's latest failure or whatever. And that's true. But let's face it, a lot of people in real estate lost big time in the recession. And I'm thinking of places like Las Vegas, California, Florida, Arizona, where, prices on homes had shot up to double or even triple and then dropped. Like I think Florida average, I don't know if it was average actually, but I saw a lot of markets in Florida, the price dropped 54% in the recession. Well, people that were counting on appreciation were actually caught, with 80% leverage. They got in big trouble. Those that invested for cash flow, which is not something I would have thought of. Again, I was swinging for the fences. Those who invested for cash flow often fared much better and often did okay through the recession. And so I think that was one surprise to me when that was the difference, really, but the importance of recognizing the difference between investing and speculating. Investing is when your principal's safe and you've got a chance to make a return on it. Speculating, in my mind, is when your principal is not at all safe and you've got a chance to make a return on it. And I spent years speculating and telling people I'm investing in this or that, but I wasn't at all. And I lost a lot of money doing that. And so that's one of the reasons we have the podcast called How to Lose Money.
No, I love that comparison there. That's well said. If you were to look back or just looking back and thinking about it all, is there one thing that you didn't think was important before that you recognize now and you look for every time going forward?
Yeah, well, I mean, not to be redundant or repeat myself, either one. That was a joke. It was that, really looking for cash flow and really evaluating the downside. Investors, a lot of investors ask, and a lot of entrepreneurs by nature, Darren, right? We're optimists. We're looking at the upside. We're looking at all that can go right. And sometimes entrepreneurs have a hard time raising capital because they're talking to investors. Entrepreneurs are talking about the upside. Investors are looking at two things, potentially three. Number one, what's the upside? That's great. But number two, what's the downside? What could go wrong? Something that entrepreneurs often miss. Every problem that you and I have, Darren, started out as a great idea.
That's funny.
But it doesn't always work out that way.
Funny and sad at the same time.
Yeah. So, but investors look at the upside. Number two, they look at the downside. And number three, the real pros. And what entrepreneurs often miss is, can I afford to withstand that downside? And so investors are looking at all three of those. And that's why entrepreneurs often fail to raise money from investors, because they're talking about all the great upsides. So I think that would be, I think my answer again on that question as well would circle around those same concepts.
No, that's good. Paul, where can the listeners go to find out more and connect and learn from you?
Well, my website is wellingscapital.com. That's WELLINGS capital.com. Our website for our podcast is howtolosemoney.com. And of course, we're on iTunes and other podcast players. I'm also involved in a project to try to fight human trafficking and rescue its victims. And I'm involved in a number of organizations, including Exodus Cry, ExodusCry.com. They put out the Nefarious movie, which if you haven't seen it, I recommend it if you can stomach the horror of it. But I'm also involved in FreedomPlaceProject.com. We're going to be building a projected $1 billion office tower or complex in Dallas, and we're going to donate 100% of the profits, the owner profits, if you will, to fight human trafficking and rescue its victims. And we're hoping to use that as a prototype all around different cities in America.
Oh, that's awesome. That's really neat. Paul, I want to say thanks for taking the time today. I've thoroughly enjoyed this, and appreciate you sharing your story and the story of your ups and downs and what you've learned. And I hope we can do it again soon.
Thanks, Darren. It's been a real honor to be on your show, and thank you to you and your listeners.
All right. For our listeners, if you like this episode, leave a comment. Love to read them. And if you haven't yet, please consider subscribing. And you'll be able to catch all of our future episodes. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.